You know, for decades, the stock market has been the undisputed king. It's been the default, right? The only game in town for anyone trying to build real wealth. But what if the king is about to be dethroned? Today, we're going to explore a really compelling case built on some serious expert analysis that suggests the stock market is just running on fumes, and an ancient asset, one that has literally outlasted every empire and every currency, is poised to take its place. Yep, we're talking about gold.
So here's the game plan. We're going to start by peering under the hood of the stock market to see if it's really as strong as it looks. Then, we'll investigate the very foundation it's all built on, the US dollar itself. From there, we'll jump back in time to see how gold has acted during past crises. And then, this is the exciting part, we'll look at the charts right now that some experts say are flashing a huge warning sign. And finally, we'll look ahead to what could be a once-in-a-generation opportunity.
This one quote from analyst Michael Oliver is pretty much the key to this whole thing. See, it's not just about a potential stock market correction, it's about what happens next. When the system, the beast, starts to crack, central banks only have one playbook: print money. And when they go berserk, as he puts it, that's when you see the real value of your savings just evaporate. It's when that hidden tax of inflation becomes a very real, very overt seizure of your wealth. And that, right there, is the catalyst that could send everyone scrambling for safety.
All right, so let's tackle the elephant in the room first, the stock market. You see the headlines, right? All-time highs. But is that the whole story? Well, the experts we're drawing from say, not even close. They argue that if you actually look past all the hype, you find a market that's incredibly fragile, propped up and honestly, showing some serious signs of exhaustion.
Now, here's a really crucial distinction we need to make. This is not about predicting a sudden dramatic crash tomorrow morning. It's about recognizing a much sneakier pattern, something called a topping process. Think of it like a car sputtering and lurching before it finally stalls out. The market churns, right? It makes a few new highs to suck people in, then it has these scary dips that shake people out. But all the while, the underlying engine is failing. The argument is that this whole process fools investors into a false sense of security right before the floor gives out, and our sources believe that's exactly what's happening right now.
So what's been fueling this bubble? According to the analysis, it isn't a booming economy or incredible corporate profits. Nope. It's a cocktail of cheap money and non-stop central bank intervention. For more than 15 years, we've been living in this world of financial alchemy, where near-zero interest rates and massive money printing have pushed investors into riskier and riskier assets. It's created a market that's high on stimulus, not on actual substance. The entire thing is built on a foundation of decaying currency.
Okay, so in a market this complex and, well, this distorted, where do you even look for the first crack in the dam? With everything seemingly floating on air, what's the one indicator that could signal the flood is coming before anyone else even sees the water rising?
And the answer is pretty fascinating. It's not the high-flying tech stocks or the latest AI craze. The analysis points to the very heart of the financial system itself, the banks, the brokers, the institutions that the Federal Reserve is sworn to protect and is absolutely terrified of seeing fail.
And when you look closely at the banks, man, the warning signs are flashing bright red. They're actually underperforming the broader market, breaking down on a relative basis. Some of the biggest names in the industry, we're talking JP Morgan, Wells Fargo, are showing signs of serious technical weakness, cracking key levels that have held them up for years. Our sources see this as a potential credit crisis brewing just beneath the surface, and here's why that is so important. A banking crisis is the one thing that will force the Fed to open the monetary floodgates and unleash that berserk reaction we talked about earlier.
But see, the problem isn't just with the assets you own. It's with the very money you use to buy them. This next part is all about the silent theft of your purchasing power. A theft that happens day by day, year after year, and most people don't even notice it.
You know, when the market gets shaky, what's the common wisdom? Run to the safety of cash. But this quote just challenges that idea head-on. It argues that cash isn't a safe harbor at all. It's a leaky boat. Every single year, the real value of that cash is silently decaying, whether the stock market is going up, down, or sideways.
We hear the word inflation thrown around all the time, but what does it really mean? Is it just the price of gas and groceries going up, like the official stats would have you believe? Or is that just a symptom of a much deeper problem?
The experts we're looking at draw a crucial line in the sand here. The consumer prices we see, the cost of living, that's just the symptom. The real disease, they argue, is monetary inflation, the relentless systematic expansion of the money supply by central banks. I mean, think about it. When you create more and more units of a currency out of thin air, each individual unit simply becomes less valuable. Higher prices are just the inevitable result.
And you don't have to be a PhD in economics to see what's happening. The evidence is hiding in plain sight, in the official data from the Federal Reserve itself. This one chart tells you everything you need to know about the debasement of the US dollar over the last couple of decades.
Prepare to be shocked. Since the year 2000, the M2 money supply in the United States has exploded by over 375%. That is not a typo. The number of dollars in the system has nearly quadrupled in just over 2 decades. This is the engine of currency debasement, and it's running at full throttle.
So, what's the big takeaway here? It's that holding cash over the long term is a losing game. It is a melting ice cube in a world of perpetual monetary inflation. Every single day you hold it, you are losing purchasing power. It's a hidden tax on your savings, and according to this analysis, it's high time to find a way to protect yourself from it.
So, if stocks are a house of cards built on a shaky foundation, and cash itself is a leaking boat, where do you turn for real safety? Well, for thousands of years, across literally every civilization, there has been one consistent answer: gold.
This is a really common belief, and you can see why. In a real panic, people just sell whatever they can to raise cash. It's a mad scramble for liquidity, and for a short period, it can definitely feel like everything is falling together. But is that actually what happens over the full course of a crisis?
Well, the historical record tells a very different story. The idea that everything goes down at once is pretty much a myth, a bedtime story for investors who haven't looked at the charts. In every major crisis, there is an alternative, a safe haven that rises above all the chaos. And more often than not, that safe haven has been gold.
Just look at the big market downturns of the last 50 years. In the stagflation crisis of the mid-70s, as the stock market cratered, gold went vertical. During the dot-com bust from 2000 to 2002, when tech stocks were just being vaporized, gold began a steady, multi-year advance. And of course, in the great financial crisis, while the world's financial system was on the brink of total collapse, gold proved its mettle once again.
Let's just zoom in on the 2008 crisis for a second. The worst financial meltdown since the Great Depression. The S&P 500 was an absolute bloodbath, losing more than half its value. It was a financial apocalypse. So what did gold do? Well, after a brief, sharp dip during that peak liquidity panic, it soared to new all-time highs, eventually tripling in value from its lows. It was the ultimate life raft in a sea of red.
Okay, so this isn't just a history lesson. Our sources believe that this historic shift isn't a forecast for some distant future. They think it's happening right now. The charts are screaming, and they argue most people just aren't listening.
Now, to understand the signals they're seeing, we need to grasp one simple but really powerful concept: relative performance. This isn't just about the price of gold in dollars. It's about who's winning the race. Is gold gaining on the stock market? Is it pulling ahead? That's what relative performance tells us, and it's a huge indicator of where the big money is starting to flow.
And that is the multi-trillion-dollar question, isn't it? When we look at these powerful comparison charts today, what's the story they're telling? Are we on the verge of a major regime change in the financial markets?
And this is where the story gets really, really exciting. The chart of gold versus the S&P 500 has just broken out of a basing pattern that was over a decade in the making. The miners are starting to outperform stocks. Silver has broken out relative to gold, which is often a signal that the entire precious metals complex is about to go ballistic. And it's not just metals. Commodities, the whole complex of real stuff, are beginning to outperform paper assets. This is a tectonic shift, and it feels like it's just getting started.
So here's the crucial point. When an asset breaks out from a base that is this large and this long, it's typically not some minor short-term event. The analysis suggests this signals a major structural shift in market leadership that could last for years to come. What we're seeing isn't the finish line, it's the starting gun being fired.
So, if we just saw the starting gun go off, what does the race look like? Well, our sources believe we're on the verge of what they call an acceleration wave, a period of explosive gains that's going to catch most investors completely by surprise.
After years and years of consolidation, of building that massive base we just looked at, the argument is that the coiled spring is finally ready to release. We're transitioning from a slow, grinding process that has frustrated a lot of people into what could be a period of rapid, dramatic price increases for precious metals as capital starts to flee other assets.
And this is, of course, the question on everyone's mind. If this acceleration actually happens, what kind of price levels are we even talking about? How dramatic could this repricing really be?
And here is where things get really wild. Michael Oliver, one of the key sources for this explainer, is calling for silver to hit between $300 and $500 an ounce. To put that into perspective, from today's prices, that's a potential 10 to 17-fold increase, and he thinks it could happen incredibly fast, in a matter of quarters, not years. He calls it a tantrum to a new reality, and it's a tantrum you'll probably want to be on the right side of.
Now, as explosive as the metals themselves could be, the analysis suggests the mining stocks are where the real fireworks could happen. Think about it like this. A miner's cost to pull metal out of the ground is relatively fixed. So if the price of gold goes up by, say, 10%, that miner's profits could go up by 50% or even more. They are a leveraged play on the entire thesis. And right now, they are trading at absolute bargain basement prices. The XAU index, a measure of mining stocks, is at a historic low relative to the price of gold. Just a return to its long-term average valuation would be a massive multi-bagger move from here.
So there you have it. We've walked through the entire argument. A fragile stock market built on monetary distortion, a fiat currency system in silent decay, and the powerful historical precedent for gold as the ultimate safe haven. The charts suggest a major shift from paper assets to hard assets is already underway. So the final question this analysis leaves us with is a simple one. Are you ready for it?